Hello, neighbors. Before we get into the episode, just a couple quick things I'd like to mention. If you go to the podcast website, neighborontheLeft.com, there's a whole bunch of things for you to check out there, including the contacts page, where you can see all of the social media links. And these days, I do post a lot of stuff just about daily on Instagram, TikTok, and Facebook. A lot of interesting stuff there. If you stop by, please like, share, and follow if you would. Also on the website, there is the episodes section where you can download or stream any episode of the podcast going all the way back to the beginning. And of course, the blog section. I make a post for every episode of the podcast, and it includes all of the sources that I use. All right, let's start the episode.
I'm going to talk about a subject people just love to talk about. Come to the floor to talk about a big scam in our country. Well, here's the sad truth. For decades now, the American people have paid into Social Security each month without having any idea if they will ever see a cent of the money that they put in. Your dollar doesn't grow, and it doesn't come back to you or your children. It's a big, gigantic, blown-up Ponzi scheme.
A scam. A government-approved Ponzi scheme. That's Senator Tommy Tuberville talking about Social Security. Now, that's not some guy on Facebook with an American flag profile picture and, 17 words all in caps. This is a United States senator, and he's not alone.
First of all, it is a legal Ponzi scheme. That's where I, revised my remarks. It's a legal Ponzi scheme. It is. It's a pay-as-you-go system.
That's Republican Senator Ron Johnson of Wisconsin. A legal Ponzi scheme. And these aren't isolated complaints about whether Social Security needs some financial repairs. There is a broader argument taking shape on the right that Americans have been badly served by the way Social Security was designed. That the government takes your money, that you could have done better investing it yourself. That younger workers are paying older retirees, and that maybe we need to start thinking about something fundamentally different. Those are pretty extraordinary claims to make about a program that tens of millions of Americans depend on every month. So what the hell are they talking about? Because here's where this gets interesting. There are parts of their argument that are true. The Social Security taxes coming out of your paycheck do not go into a little account in Washington with your name on it. Most of that money is used to pay people who are receiving Social Security right now. And yes, Social Security has a very real financial problem coming down the road. So when Republicans point at the way the system is financed and say, look at this, younger workers are paying older retirees, they're not inventing that part. But the question is, does that make Social Security a Ponzi scheme? Were Americans actually conned? And when politicians say you'd be better off investing that money yourself, what would that actually mean? What happens to the people who are retired today if tomorrow's workers start putting some of that money somewhere else? Who takes the risk? Who makes the money? And perhaps most importantly, what are these politicians proposing that Social Security eventually become? Because before I tell you why I think their prescription is dangerous, I want to do something political commentary doesn't always do very well. I want to give you the strongest version of their diagnosis. And to do that, we need to start with something surprisingly few of us ever really were taught. How Social Security actually works. Hello, neighbors, and welcome to Your Neighbor on the Left, the podcast about progressive politics, human decency, and life on the blue side of America's ideological divide. My name is Don Spielis, and I am your host. And today we're talking about Social Security. And I want to be clear right up front about where I land on this, because I'm not going to spend the next 45 minutes pretending that I'm a neutral referee standing between two equally appealing versions. I am not that at all. I do not want Social Security privatized. I do not want part of your payroll taxes directed into Wall Street investment accounts. And I sure as hell don't want Social Security turned into something Congress gets to drag into the bargaining table every year during the latest budget hostage crisis. My preference is much simpler. Strengthen the program we already have. And before we start talking about cutting benefits, raising the retirement age, or telling working people they should take on more market risk, I want wealthy earners paying Social Security taxes on a much larger share of their wages than they do now. That's where I'm going to end up. But I don't want to skip the argument that gets us there, because Republicans like Tommy Tuberville, Ron Johnson, Mike Lee are pointing to real features of Social Security when they criticize it. There is a funding problem. There is no personal account with your name on it. And yes, if you had invested some of that money privately for 40 years, there are circumstances where you might end up with more. So before we start throwing punches, let's make sure we understand the ring. What is Social Security actually designed to do? Where does the money go? What are you really paying for? And once we understand that, we can talk about whether these guys are exposing a scam or trying to redefine a program that was never supposed to work the way they say it should. So, before we get into whether Social Security is a scam or a Ponzi scheme or some giant government shell game, we need to understand what it actually is. And the first thing to know is this: Social Security is not a retirement account. It is social insurance. And that's a big difference, a difference that matters. When Social Security taxes come out of your paycheck, that money does not get deposited into a little account with your name on it, where it sits for 40 years waiting for you to retire. Most of the money coming in today is used to pay benefits to people receiving Social Security today. Retired workers, widows and widowers, people with disabilities, children who lost a working parent. That is how the system was designed. Now, when Social Security has taken in more money than it immediately needed, that extra money has gone into the Social Security trust funds. And this is another place where people get confused. The trust funds are not giant vaults stuffed with cash. The Treasury manages them, and the money not needed immediately for benefits is invested in special U.S. Treasury securities. Those securities earn interest, and when Social Security needs the money to pay benefits, Treasury redeems them. That is how the Social Security Administration describes the system. So when somebody says the government spent the Social Security money, there is a piece of truth buried inside that sentence, but it can be very misleading. Treasury does not use the cash it receives from selling those securities for general government financing. But Social Security receives Treasury securities in return. Those are obligations of the United States government. They are not monopoly money. And Social Security itself is actually two trust funds. One pays retirement and survivor benefits, the other pays disability benefits. That broader mission is important because when politicians start comparing Social Security to what you could have earned in the stock market, they're usually talking as though this whole thing is just a retirement investment, and it isn't. If you become disabled before retirement, Social Security may protect you. If you die and leave a spouse or children behind, Social Security may protect them. If you retire and live another 30 years, Social Security keeps paying. And those retirement benefits are adjusted for inflation. So yes, you pay into the system during your working years, but what you are buying is not simply a pile of money waiting for you at age 67. You are buying insurance against a whole collection of things that can happen over the course of a life. And that distinction is going to matter a lot when we get to the argument Republicans are making. Because if you judge Social Security like a 401k, it can look like pretty strange investing. But that's because it isn't an investment, it's insurance. So now that we know what Social Security actually is, let's give the Republican argument its best shot. Because there are several things they point to that are factually true. First, Social Security is largely a pay-as-you-go system. In plain English, that means the money coming out of workers' paychecks today largely helps pay the benefits of retirees today. And yes, if you strip that down to one sentence, it sounds a little like the thing Republicans keep saying. New people are paying old people. That is one surface level similarity to a Ponzi scheme. Second, you do not personally own a pile of money somewhere with your name on it. There's no vault in Baltimore, labeled Don's Social Security money, do not touch until he retires. That money is part of a national insurance system. Third, the private investment argument is not imaginary. Tommy Tuberville has argued that if he had been allowed to invest money he paid into Social Security over his working life, he could have ended up with far more wealth than he receives from Social Security now. And depending on someone's earnings history, how long they've worked, how they invested, and what the market did over those decades, that can absolutely be true. Stocks have historically been very good at building wealth over long periods. So if the question is simply, could somebody have invested this money and ended up with more? The answer can be yes. And fourth, Social Security really does have a financing problem. That part is not Republican propaganda. The 2026 Social Security Trustees Report says the Retirement and Survivor Trust Fund is projected to be able to pay full schedule benefits until the fourth quarter of 2032. After that, if Congress did absolutely nothing, incoming revenue would still cover about 78% of the scheduled retirement and survivor benefits. If you look at the retirement and disability programs together, the combined reserves are projected to last until 2034, with about 83% of scheduled benefits payable then. So when you hear somebody say Social Security is going bankrupt, that's misleading. The program does not simply vanish when the trust funds run down. Payroll taxes keep coming in. Benefits keep getting paid. But under current law, there eventually would not be enough money coming in to pay every dollar of the benefits that people have been promised. And that is a serious problem. And demographics are a big reason why. Decades ago, there were many more workers paying into Social Security for every person collecting benefits. In 1960, there were about 5 covered workers for every beneficiary. By recent decades, that ratio has fallen to roughly 3 workers per beneficiary, and it continues to trend downward. The baby boom generation retired. People are living longer. Birth rates are lower than they once were. So you have fewer workers, relatively speaking, supporting more retirees for longer periods of time. And that math matters. And this is the point where I want to be very fair to Tuberville, Johnson, and Lee, and anybody else making this argument. If they say Social Security's current financing structure is under real strain, they are absolutely correct. If they say you don't have an individual investment account, they are correct. If they say some people could earn more by investing privately, they are correct. But none of those statements gets you automatically to the conclusion, therefore, Social Security is a scam. That is a Grand Canyon-sized leap. And that's the leap we need to look at next. So let's deal with the phrase itself, Ponzi scheme, because it sounds devastating. And if Social Security really were one, that would be a pretty damning indictment. But a Ponzi scheme is not just any system where a Ponzi scheme is fraud. And that part matters. The operator tells people their money is being invested. They claim those investments are generating returns, but the returns are fake. The money from newer investors is secretly being used to pay earlier investors, and the whole thing survives only as long as enough new money keeps coming in. The deception is the scheme. Social Security does not work that way. Nobody at the Social Security Administration is telling you your payroll taxes are sitting in the S&P 500 earning 12%. Nobody is pretending your contribution is parked in an individual retirement account. The basic financing structure is very much public. The trust funds are public. The projections are public. The government publishes enormous reports every year telling us how much money is coming in, how much money is going out, and when the reserves are expected to run short. This would be the strangest Ponzi scheme in history. Every year, the supposed scammers issue a giant actuarial report saying, here are the books, here's the problem, and here's roughly when we expect the money to get tight. That's not a Ponzi scheme. That's not how Bernie Madoff operated. Now, that does not mean you have to like the way Social Security is financed. You can absolutely argue that pay-as-you-go system is vulnerable when the population gets older and the ratio of workers to retirees falls. But that is a legitimate concern. But a financing model you dislike is not automatically fraud. And there's another reason the comparison breaks down. A Ponzi scheme pretends to be an investment. Social Security does not. That distinction takes us right back to the thing we talked about earlier. An investment account asks, how much did my money grow? Social Security asks, what happens if my life does not go according to plan? What if I were to become disabled at age 42? What if I die and leave children behind? What if my spouse dies? What if I live to be 102? What if I retire right after the market loses a third of its value? Those are not investment return questions. Those are insurance questions. And once you remember that, the whole I could have made more money in the market argument starts looking a lot less complete. Because maybe you could have. But Social Security was never designed to beat your brokerage account. It was designed to make sure that when life goes sideways, there's still something underneath you to support you. So no, the fact that today's workers help pay today's retirees does not make Social Security a Ponzi scheme. It makes it a social insurance program with a real financing problem. And those are two completely different things. So now we get to the phrase that sounds simple, but it really isn't. Privatizing Social Security. What does that actually mean? Because it does not usually mean the government stops taking Social Security taxes out of your paycheck, hands you the money, and says, good luck, buy stocks, buy bonds, buy a bass boat, whatever you want. That is not how the major Republican personal account proposals have generally been structured. The George W. Bush plan is a good example. Under that proposal, workers could have chosen to divert part of their payroll taxes into a personal retirement account. But the money would still have been restricted. You wouldn't have been day trading meme stocks from your couch. The Bush administration proposed a limited menu of broadly diversified stock and bond funds similar to the federal thrift savings plan. And the accounts would have had rules governing withdrawals in retirement. So this is important. When conservatives talk about giving you control over Social Security money, they're generally not talking about eliminating mandatory retirement savings. They're talking about changing where some of that mandatory money goes. Instead of all of it flowing into Social Security, some portion would go into an investment account tied to you. And there is an appeal to that. You can see the account, you can watch it grow, you own the asset. Maybe you can leave some of it to your family. And over a long enough period, if the market performs well, you may earn more than you would get by looking only at Social Security and its implied financial return. That is the sales pitch. But now comes the problem. Remember what we established earlier. Your Social Security taxes today are helping pay someone who is retired today. So imagine Congress says, starting next year, you can take part of the Social Security tax coming out of your paycheck and put it into your own investment account. Okay, that's great for your account, but Mrs. Johnson down the street is 82. Her Social Security check is due next month. She does not suddenly need less money because your payroll taxes went into an index fund. So who pays her? That is what's known as the transition problem. And there are only so many places the money can come from. The government can borrow it. It can raise other taxes. It can cut spending somewhere. It can reduce Social Security benefits, or it can cobble together some combination of all four of those things. But the whole does not disappear just because we now call the new account personal. And this is why the phrase, let people invest their own Social Security money, it is deceptively simple. We're not starting a brand new retirement system from scratch. We already have generations of people receiving benefits from the existing one. You cannot redirect the incoming money without dealing with the obligations that money was already helping to finance. And then there's the other major change, risk. Under traditional Social Security, your retirement benefit is determined by a formula established in law. Under a personal investment account, at least part of your retirement outcome depends on what your investments do. Maybe they do great. Maybe they don't. The Bush administration itself acknowledged that market swings near retirement were a concern and proposed rules intended to limit that risk. So privatization doesn't mean that government disappears. It doesn't mean that there are no rules, and it certainly doesn't mean somebody just hands you your payroll taxes. What it means is that part of Social Security begins changing from a guarantee backed by a national insurance system into an individually owned investment account. And once you make that change, two questions immediately follow. Who fills the hole left in the existing system, and who carries the risk if those investments don't perform the way everyone hoped they would? Now, let's talk about Ron Johnson, because his argument goes beyond calling Social Security a Ponzi scheme. In 2022, Johnson said he wanted to turn everything in the federal budget, including Social Security and Medicare, into discretionary spending. Now, I know that sounds like budget speak, but let me translate it. Right now, Social Security is mandatory spending. If you qualify under the law, your benefit gets paid. Congress does not have to sit down every year and decide whether Social Security gets another 12 months of funding. Johnson's idea was to make programs like Social Security subject to regular congressional review instead. His argument was that too much of the federal budget runs on what he called automatic pilot, and Congress needs to look at these programs more closely and fix what is financially unstable. That is the charitable version. And here is my problem with it. Congress can already reform Social Security right now. They can change the tax rate. They can change what wages are taxed. They can change benefits. They can change the retirement age. They can change the formula. They can change cost of living adjustments. There is no magical force field around Social Security preventing Congress from fixing it. So if Congress already has all of that authority, what exactly do we gain by turning Social Security into something that gets dragged back into the budget fight over and over and over again? And the answer is leverage. That is what changes. Because we have seen what happens when programs become targets during budget negotiations. Congress used the 2025 budget reconciliation process to make major changes to SNAP, the food assistance program. The Congressional Research Service says the law reduced federal SNAP spending and changed eligibility and benefit rules in ways expected to make it harder for many people to qualify and reduce benefits for some households. And as I am recording this, Congress is once again negotiating temporary funding just to avoid another government shutdown when their fiscal year ends. Now, I want to be precise here. Ron Johnson did not say, I want to cut everybody's Social Security check. That would be putting words in his mouth. But what he proposed would move Social Security closer to the world where funding becomes part of recurring political negotiations. And I want absolutely no part of that. I've heard the way that Republicans like Mike Johnson and so many others talk about things like Social Security. And I want no part of that being part of the yearly budget, melee that happens every year. Because imagine every budget showdown coming with another round of what do we cut, what do we freeze, what do we trade away to get 60 votes, which program becomes the bargaining chip this time. Social Security should not become another hostage in that process. And keep in mind, there are virtually no members of Congress who rely on Social Security or will rely on Social Security for their retirement income. That's an important piece of the puzzle as far as I'm concerned. If Congress wants to reform Social Security, fine. Write the bill, make the argument, vote on it, own it, but do not turn a retirement guarantee Americans spend their entire lives working for into something Congress gets another chance to squeeze every time Washington decides to have its semi-annual nervous breakdown over the budget. And now we get to the part that always makes people uncomfortable. Follow the money. Because if you take hundreds of billions of dollars in payroll taxes that currently flow through Social Security and start routing some of that money into private investment accounts, that doesn't happen in a vacuum. Somebody has to manage those accounts. Somebody has to hold the assets. Somebody has to administer the system. Somebody gets the business. And historically, Wall Street has understood that very, very well. During George W. Bush's push for private Social Security accounts in 2005, the Securities Industry Association, Wall Street's main trade group at the time, had long supported private accounts and was actively discussing lobbying strategy around the proposal. Financial firms and business groups were tracking the debate closely because, depending on how the system was designed, they stood to gain new customers and new assets to manage. And later reporting showed that firms specializing in large, low-cost index funds, companies like Vanguard and Barclays and State Street, were viewed as likely early beneficiaries if private accounts were created. Now, let me put a guardrail around that. That does not mean every Republican who supports private accounts is secretly taking orders from Wall Street. That's not something I can prove. And I'm not going to pretend that I can. It also does not necessarily mean the fees would be enormous. In fact, during the Bush debate, factcheck.org found that some claims about gigantic Wall Street fee bonanzas were exaggerated because Bush wanted the accounts modeled on the federal thrift savings plan, which operated with very low management costs. But low fees do not mean no financial interest. They mean we should make the argument accurately. If millions of new accounts holding enormous amounts of money are created, financial firms gain assets to manage. That is an economic incentive. And we can see a version of that infrastructure being built right now with Trump accounts. As of July, Treasury selected funds from State Street, BlackRock's iShares, and Vanguard for those accounts. The default investment is a State Street S&P 500 fund with other broad market funds available from State Street and BlackRock and Vanguard. Those are low-cost accounts, and that's good, but they are still private financial assets being managed by some of the largest investment firms on the planet. So when critics say Wall Street has something to gain from a future system built around personal Social Security accounts, that is not a fever dream. The important question isn't, can I prove Senator X supports this because BlackRock whispered in his ear? The important question is, who benefits if trillions of dollars that currently flow into a public insurance program increasingly flow into private financial markets? And then there's the political side of this. We have this terrible habit in America of treating the stock market like the economy scoreboard. The Dow is up, the economy's good. The S&P hits a record, everybody must be doing great. Except the Dow doesn't pay your rent and the S&P doesn't tell you whether you can afford groceries. Your 401k going up does not tell us whether somebody working 2 jobs can afford insulin. So imagine what happens if we start pouring huge amounts of retirement money into private investment accounts. Markets rise and account balances rise, and politicians are then able to point at the chart and say, look, privatization is working. Maybe. But if the government had to borrow hundreds of billions to keep paying current retirees while that money was being diverted into private accounts, then we haven't magically created prosperity. We have moved money around, changed who manages it, and changed who carries the risk. More money flowing into Wall Street is not automatically the same thing as more security on Main Street. And that distinction matters a hell of a lot when the money we're talking about is supposed to help keep people out of poverty when they can no longer work. And this is where I think privatization arguments start looking very different depending on how much money you already have. Because market risk is not evenly experienced. Take 2 people. Okay, person A has $12 million invested. Person B has $140,000 invested. The market drops 30%. It's the same percentage loss for both A and B. Person A loses a fortune on paper. Person B may lose money they were counting on to pay the mortgage and buy groceries and cover prescriptions and get through the next 20 years. Same market, same decline, completely different life consequence. That's what wealth does. It gives you room to wait. If you have millions of dollars in the market and it tanks, you may be able to leave the money alone for 5 years and wait for the recovery. If you're 67 and need that money next month, you don't have 5 years. You have Tuesday. And there is actually a name for this problem. It's called sequence of returns risk. A wonderful phrase that no one would ever be able to decipher just by looking at it. It sounds like something invented specifically to make normal people stop listening. But here's what it means. A market crash is much more dangerous when it happens right when you retire and start taking money out. If the market falls while you are, 35 and still contributing every month, you have decades for it to recover. If it falls when you're 67 and you immediately have to start selling investments to live, you are selling while prices are down. That can do huge lasting damage to how long your savings survive. Now compare that with Social Security. Your Social Security check does not get 30% smaller because the Dow had a terrible quarter. If you live until 95, the payments do not stop because your personal account ran dry. And again, the protection extends beyond retirement. If you become disabled during your working years, Social Security may pay benefits. If you die and leave a spouse or children, survivor benefits can kick in to support them. You cannot evaluate those protections by asking simply what the S&P 500 averaged over 40 years. They are very different things. And this is why I keep coming back to the word risk. Privatization does not eliminate retirement risk. It moves more of that risk from the system to you. To you. And I'm not saying ordinary people are incapable of investing. Of course they are. Millions of working people have 401ks and IRAs right now. The question is whether we should make more of their basic retirement security depend on investment performance. That's the question. Because the people who can least afford a bad outcome are the people most dependent on Social Security in the first place. If you're wealthy and your personal retirement account underperforms, you have options. If Social Security is your financial floor and we weaken that floor, your options get a heck of a lot thinner. Now, that is not an argument against investing. It's an argument for having at least one piece of retirement security that does not care whether Wall Street happened to have a good year when you need the money. Now we get to the part where this stops being just a theoretical argument, because personal Social Security accounts are not a new conservative idea. As I said, George Bush pushed for them hard after winning re-election in 2004. His proposal would have allowed younger workers to divert part of their payroll taxes into personal retirement accounts invested in a limited menu of stock and bond funds. But Bush did not describe that as dismantling Social Security. He described it as giving workers ownership choice and the chances to earn more through the market. And politically, it went nowhere. Social Security was the third rail then for the same reason it is now. People depend on it. People are terrified of losing it. And people get very nervous when politicians start talking about replacing guarantees with market accounts. So keep that history in the back of your mind. Because now, fast forward 20 years. In July of 2025, Treasury Secretary Scott Bessent was talking about the new Trump accounts for children. And he used a phrase that caused immediate political firestorm.
I'm not sure when the distribution level date should be, whether should it be 30 and you can buy a house, should it be 60, but in a way, it is a backdoor for privatizing Social Security.
A backdoor to Social Security. Just what I was looking for from the Trump administration, backdoors. Now, to be fair, Bessent did walk that back and say that he meant Trump accounts to be supplements to Social Security, not to replace it. And the Trump administration publicly maintained that it was committed to protecting the existing program. So if that were the only quote we had, I would not build some giant conspiracy around it. But then came Ted Cruz. In May of this year, Cruz was speaking at the Milken Institute global conference about Trump accounts, which he helped create. And he said this.
Conservatives in America for 50 years have been trying to do that, have been trying to do Social Security personal accounts. Here's the dirty little secret. Trump accounts are Social Security personal accounts.
Now, the reason I put the actual clip in there is because I want you to know that that is not me interpreting what he said. That is Ted Cruz. And he went further. Cruz connected Trump accounts directly to the conservative effort to create personal Social Security accounts. His argument was basically this: give children investment accounts, let families watch those accounts grow over decades, let people experience compound investment growth firsthand, and once people become comfortable with that model, maybe they'll start asking why some of their Social Security payroll taxes could not go into personal investment accounts as well. And this is important because now the conversation changes. We're no longer talking only about Democrats or Social Security advocates saying, watch out, these people secretly want to privatize Social Security. Some prominent conservatives are telling us themselves that personal accounts are part of the long-term conversation about Social Security. That doesn't mean every Republican who calls Social Security a scam wants the exact same thing. It doesn't mean there's one secret master plan sitting in a drawer somewhere, but it does mean privatization is real. The history is real. The policy idea is real. And the effort to make personal investment accounts politically more familiar is real. So when you hear Ponzi scheme and when you hear scam, when you hear you could have done better investing yourself, I think it is perfectly reasonable to ask whether those arguments are simply complaints about Social Security or whether they are helping prepare people for a fundamentally different version of it. So if I don't want private Social Security or privatized Social Security, and I don't want to start cutting benefits or making people work longer, what is it that I do want? Well, let's start with the cap. In 2026, Social Security tax applies only to the first $184,500 of covered wages. After that, the Social Security portion of the payroll tax stops for the year. So let's make that real. If you make $60,000 a year in wages, you pay Social Security tax on all $60,000. If you make $100,000 a year, you pay it on all $100,000. If you make $1 million in wages, you pay Social Security tax on the first $184,500, and then you're done. So the person making $60,000 a year pays Social Security tax on 100% of their wages. The person making $1 million pays it on about 18%. Now, I want to be precise here. I'm talking about wages and other covered earnings subject to Social Security payroll tax. I'm not saying capital gains, dividends, or somebody's entire net worth are currently treated the same way. But when it comes to wages, I have a very simple question. Why would we do it that way? Why should the person making 60 grand keep paying Social Security tax on every paycheck all year long while the person making $1 million hits a ceiling and stops? And this is where you usually hear the response from the high earners who will say, well, if you're going to tax me on all my wages, then shouldn't I get a much bigger Social Security check too? And my answer is no, not proportionally. Because once again, Social Security is not your personal savings account. It is social insurance. The system already does not operate on a perfect dollar in, dollar out basis. Somebody pays in for decades and dies shortly after retiring. Somebody else lives to 102 and collects benefits for 35 years. Somebody becomes disabled at 40. Somebody dies young and leaves a spouse and children who receive survivor benefits. That's what pooling risk means. Now, there are different ways Congress could change the cap. They could eliminate it completely and tax all covered wages. They could tax those additional wages and give people some additional benefit credit. They could tax the additional wages but give little or no extra benefit credit. Or you could create what people sometimes refer to as a donut hole, where the tax stops at the current cap and then starts again once wages reach a much higher level. Now, those choices matter. And here's the part I don't want to oversell. Removing the cap would help Social Security enormously, but depending on how you do it, it doesn't necessarily solve the entire problem by itself. The Social Security actuaries have modeled this. If Congress eliminated the taxable minimum and applied the full payroll tax to all covered earnings without giving any additional benefit credit above the current cap, the actuaries estimate that would eliminate about 67% of the program's 75-year actuarial shortfall. If those extra taxed earnings also generated additional Social Security benefit, the improvement falls to about 48% of the long-range shortfall. So no, I'm not telling you lift the cap and everything's fixed. It isn't. But 2/3 of the long-term financing gap is not pocket change. And the CBO has looked at less aggressive versions too. One proposal that would subject wages above $250,000 to payroll taxes was estimated to reduce federal deficits by about $1.4 trillion over 10 years. So when somebody tells me we have to start the conversation about benefit cuts for Social Security or raising the retirement age or putting workers' retirement money into private accounts, I'm going to ask why we skipped over this part. Why is the factory worker or the roofer supposed to work longer before the millionaire is asked to keep paying Social Security tax after hitting $184,000? That's where I start. Not because it solves every dollar of the problem, because before we can start asking ordinary workers to give up security, I want the people earning the most to contribute on a much larger share of their wages. That seems pretty damn reasonable to me as a place to begin. And I think this is where the whole debate finally gets stripped down to what it actually is. What do we want Social Security to be? Because the conservative argument increasingly starts from a very different question than mine. Their question is, why shouldn't I control more of this money myself? Why shouldn't I invest it? Why shouldn't I own the account? Why shouldn't I try to get a better return? And none of those are stupid questions. We already encourage people to do exactly that with 401ks and IRAs and pensions and brokerage accounts and these Trump accounts now. We have plenty of places in this country where the goal is to build wealth. And markets are very good at doing that over long periods of time. But Social Security was not built primarily to maximize wealth. It was built to guarantee security. That's the divide. One side increasingly emphasizes ownership, investment returns, and personal accounts. I care more about the floor. What happens if your investments underperform? What happens if you become disabled? What happens if your spouse dies? What happens if you live 25 years longer than you expected? What happens if the market crashes at exactly the wrong time? That is what Social Security is there for. And I don't think every part of retirement should depend on whether somebody made the right investment choices 40 years earlier. I especially don't think the answer to Social Security's funding problem is to take the one part of retirement that is deliberately insulated from Wall Street and make it more dependent on Wall Street. We already have investment accounts, and we should have them. People should save, people should invest, people should build wealth if they can. But there should also be one piece of the system that says you worked, you contributed, and no matter what the market does, no matter how long you live, no matter what bad luck shows up along the way, there is still something underneath you. That is what I think Social Security is for. And if we forget that, then we are not really talking about repairing Social Security more. We're talking about replacing its basic purpose with something else. So, let's jump back to where we started. It's a scam. It's a Ponzi scheme. Those are powerful words, and they are useful words if what you're trying to do is convince people that Social Security is not merely underfunded, but fundamentally illegitimate. But that is not what the facts show. Social Security has a financing problem, a real one, and Congress has to deal with it. But a program can need repair without being a fraud. And the choice is not between pretending nothing is wrong and handing the whole thing over to Wall Street. There is another path. Strengthen the program that already exists. Make more high-end wages subject to Social Security taxes. Ask wealthy earners to contribute on a much larger scale of their wages before you ask ordinary workers to accept smaller benefits, later retirement, or more market risk. And yes, even that does not magically solve every dollar of the long-term shortfall. Fine. Then we keep working. We find the rest. But we do not start by tearing out the part of Social Security that makes it Social Security. The guarantee, the shared risk, the idea that not every bad turn in life should be yours alone to absorb. Because we already have plenty of ways to gamble on growth, 401ks and IRAs and brokerage accounts and investments, and all of those things have a place. But Social Security should be different. It should be the floor. The thing underneath you when the market crashes, when you live longer than expected, when disability hits, when a spouse dies, when life does what life does. Social Security needs repair. It does not need to stop being Social Security. And I want it to remain the part of retirement that Americans do not have to gamble. All right, everyone. Thank you so much for taking the time to download and listen to this episode of Your Neighbor on the Left. I can't tell you how grateful I am that you did. I would love to hear your opinions on this. At the beginning of the episode, I talked about how you can get in touch with the podcast, and I hope that you do. Let me know what you think about this topic or any other topic for that matter. I will be back on Wednesday with another episode of Your Neighbor on the Left. So between now and then, do me a favor, stay engaged, stay kind, and have the kind of week you'd wish for others.